Well, good morning, everyone. I see we still have some people logging on, but I've got 9 o'clock straight up, so I think we're going to get started at least with the intro and housekeeping items. So welcome everybody who's logged on to the fifth installment of the JCCS live Q&A webinar on COVID-19 relief for businesses. Today we're going to be breaking down the application for forgiveness and the instructions that were issued by the SBA on Friday late in the day. I know there's a lot of maybe some misinformation that's floating around out there, a lot of articles. So we're going to try and break that guidance down and really try and give you what our significant takeaways are from those instructions. First, a couple of standard housekeeping items. Again, we're recording this session, and this session will be available on our website probably a little bit later this week, possibly even end of day tomorrow, as well as the slides will be available for download as well. Also, just want to make sure we're directing all the questions to the Q&A chat box. And of course, you can vote those questions up as you see something that's logged in there that piques your interest. So let's make sure we get the most popular questions up to the top. And then of course we do have the chat box as well, and that's more for technical issues, and we'll be monitoring both of those, but let's try and get our questions related to the content in that Q&A area. And then also we're going to try and stick to that 1 hour discipline again. I think our content is, we should be well short of an hour on our content today, so we should have plenty of time for any questions that you folks have, which I know there are quite a few. So with that, I'm going to hand it off to Jake Carter to get started with some kind of opening comments and thoughts.
Probably should unmute myself so people can hear me. Thanks, Tony. Good morning, everyone. So I think the main subject here is that, as a lot of you probably are aware, that the SBA came out with an application to start documenting and accounting for all of your expenses that you're spending your PPP funds on. And so that was, that's great to see. It seems like anymore, though, whenever we get something from the SBA, the IRS, especially in this field, it tends to pose more questions than answers. And that's kind of the case here, but we've been diving through the whole application, looking through it all. And for the most part, they did a pretty good job. I think we still have a few outstanding items we hope to get further guidance on. But in general, we got a 12-page application. Probably about half of it's instructions and half of it instructions and definitions. And the other half is actual content that you're filling out. Some abbreviated areas that if you have more than 10, 15, 20 employees, it can get far more detailed than what this application looks like. But for the most part, a pretty streamlined application. The instructions are pretty straightforward. They got some definitions listed in there that are helpful. So be sure to check that out. The SBA has that posted on their website. We are not going to go you're not going to see it on our slides here much, a couple of snippets here and there. So that's something that you're going to have to either seek out us for help for, or check it out yourself to review that. I think what is still needed in what I think probably the most buzz out there, we get the question, I think we are getting it dang near hourly, is have they extended the 8-week period? And the current answer is no. Obviously, there's a lot of government push to get that extended. It's definitely weighing on a lot of people's minds that they are trying to figure out ways to spend this money, and due to some of the limits, it's making it difficult to do so. So that's one of the big questions. Then I'm trying to maybe relax some of the rules on 75% spent on payroll, 25% non-payroll costs. Those are maybe some easing or relaxing of those rules is what we are maybe hoping to see. But again, that's just stuff that we're hearing, but it is not. The rules are still very well set in place on what we can use those funds for. So that's kind of the basic area there. I'll let Aaron take it from here, or Tony, perhaps.
Yeah, so I'm going to get started with maybe some significant takeaways, and I guess kind of play off of what you had started talking about there, Jake. Maybe just kind of close the loop on what you've heard about the time period in which people should apply.
Yeah, so when you look at the application, I think it's probably good to know that you have a deadline. The deadline is October 31st of 2020. And that's when you have to get the application ultimately in by. A lot of people on this webinar, or just a lot of clients, we're probably getting their loans in mid-April, mid to late April. So if we fast forward that 8 weeks, you're looking at a mid to late June. There's been talks. Some people are maybe trying to push the application in sooner if they use up all their PPP funds by week 6 or 7. They could put that in early. That June 30 date is kind of a key piece to a lot of different. We'll talk about that date a lot, I think. So to send in something before June 30 seems a little premature. However, if you don't need to use that date as a piece in one of your equations, you could send it in sooner. And I don't know, with as much guidance as we think we maybe need, I'm one to maybe slow roll it a little bit and just, we're trying to tell people to keep track of things, but at the same time, to be diligent and swift, but at the same time, I think we need to be careful in rushing this process too.
Yeah, I think there's enough shifting landscape that, maybe a little bit of patience. Don't rush to send that application in is kind of the message, right?
Yep.
Okay.
Hey, Jake,
Great.
was there some talk about the EIDL grants and how that affects forgiveness?
Yeah. So a lot of viewers, and I've got a lot of clients that are starting to finally see some dollars come in from the EIDL, and it wasn't very few. Well, I shouldn't say very few. It's been a handful. Some people are getting 1,000, 2,000. It's usually been a multiplier of the number of employees they add times 1,000. So some people are getting the full 10,000, and I think Tony will talk about that a little bit too. But in general, yes, there is going to be some rules here that we talk about that show how you account for the EIDL. It is going to be something that reduces the PPP loan forgiveness aspect.
Yeah, and I don't think we specifically have a slide on that, but really they've got, in the instructions, they're specifically stating that the SBA is going to reduce the amount that they reimburse the bank for by the amount of any EIDL advance. So the expectation is that whatever your forgiveness number is, you can add back in your EIDL advance. So unfortunately, that is going to be a part of your loan. So. Well, with that, I'm going to start jumping into some of these significant takeaways in the application itself. One of the nice features that they did build in is this alternate covered period election. It is only eligible for businesses with a biweekly or less frequency payroll period. So if you're biweekly or weekly, you can elect to shift the beginning of your covered period to the first day of your next payroll following the date of the funding of your loan. Everybody else, semi-monthly or monthly payrolls, you got to follow the original guidance, and your covered period starts the day that your loan was funded. So then I want to kind of touch on how they talk about eligible payroll costs, because there's some implications here that are maybe a little bit divergent from the language in the Act. They're defining payroll costs so they're defining incurred as the date that the wages were earned, okay? And then there's some suggestion that that incurred date needs to fall within the covered period. So that would require some allocation of that payroll. That's significantly different than we've read the act initially. That's not hard and fast. I've read a lot of guidance on both sides of that issue. So anyways, just kind of word of caution that incurred definition appears like we need some additional clarification from the SBA on it. Are we required to allocate that first payroll to include only those dates that are incurred in the covered period? Or can we just look at it's incurred in the February 15th to June 30th time period and paid during the covered period, which is how the act reads. So we're looking for a little guidance on that. And I think it's going to be what we've always interpreted it to be. So focusing on that paid date. And you'll kind of see why we think that based on the non-payroll costs when we get into that a little bit later. But they also have this exception to the paid rule. So Aaron, do you want to kind of maybe explain how that works and maybe some examples?
Right. So there is an exception to the paid rule. If the payroll costs are incurred but not paid at the end of the covered period, they're still eligible for forgiveness as long as they are paid on a normal schedule for that pay period. So if you have a payroll that would normally fall after your 8 weeks ends, but it includes time that the employees earned during that 8 weeks, you can basically include those earned wages in your forgiveness, even though you didn't pay them until after your 8-week period. We do need to watch those allocations for those wages. If you had 1 week, if you're a biweekly payer and you had 1 week within the covered period that the wages were earned, and then the following week was outside of that 8-week period, you just want to make sure that you're allocating those wages appropriately, where that first week of wages can be included in forgiveness, but the second week can't. So you'll want to make sure that you're kind of having some way to track that if you are deciding to pay on your regular pay rate or pay date. I know that in talking in the past, we've talked about having a special payroll run for the very last day of the covered period to capture any wages that were earned within the 8 weeks. And I still think that's probably the cleanest way to keep your allocation correct or easily identifiable. But you can definitely just run it on your regular payroll schedule and still include those incurred and earned wages as a part of your forgiveness that you get. Anything else on that exception, Tony?
No, I think that's the message. I mean, really the big one is we've had a lot of clients say, well, should I run this short payroll? Mm-hmm. And, that's cumbersome for a lot of employers, especially if you've got significant number of employees. It's not an easy task. Yeah. So the message is you don't have to. So great add-on by the SBA. I think this is another very positive item that's in this.
Right. When you have finished up your 8 weeks and you're looking to start gathering documentation for payroll, they're going to ask for a couple of different items. Your bank account statements, if you pay payroll directly out of your bank account, or if you use a third-party payroll service, they may ask for some reports showing the payroll that is the actual disbursement of the funds to the employees. If you do direct deposit, this is going to be very easy because it's usually one lump sum coming out of your bank, and you can usually print a register out of your payroll software, or your payroll provider can provide something that breaks down that direct deposit for the employees. If you're writing physical checks, maybe a little bit more difficult because you may have employees that don't cash those checks all at the same time, or they may go to the following month. So I think we're going to see a little bit of difference there on the cash compensation that's paid to the employees. Your other items are your tax forms, which we've always expected, your 941s, your state unemployment forms, The guidance does say that they'll ask for a listing of employee earnings by employee. And so if you have a form or a tax form that doesn't show that information, then I expect that they'll ask for some kind of payroll summary or payroll register that shows that. I know here in Montana, our unemployment form that we file every quarter includes an employee listing with each employee and their gross wages. So that may be sufficient for the banks and the SBAs or SBA. And then lastly is the payment receipts, canceled checks, account statements showing the employer paying either the group health insurance premiums, the retirement contributions that you've made. I know we do a lot of those online now, so a breakdown of the payment that shows the date that it was paid and potentially a follow-up showing the funds coming out of the bank account are what's going to be requested for the payroll itself. There are some other requirements in regards to payroll, and that's around the FTE and how you're showing the calculation of the FTE. And their guidance here is not very specific. It just lists documentation showing average number of FTE employees on payroll during whichever look back period you choose, and which could be your tax filings, your state filings. I believe there's some in Washington, a couple other states where it actually shows hours worked, but most of the tax filings don't seem to show any hours components. So this may be something that you can't rely on a tax form to provide. You may have to pull some kind of documentation from your payroll software or put it together in Excel to prove your FTEs. And we'll talk a little bit more about the FTE calculations in a little bit. Did I miss anything on those, Jake, Tony?
No, I think what I'd like to do maybe is cover those top 3 questions before we move off of payroll costs.
Okay.
Here, Aaron. So one that's kind of common here, I think the first and the third are looking at the same concept of can I give hazard pay to my employees, or can I bonus my employees during the covered period?
Correct me if I'm wrong, but I don't believe the SBA application had any change to the guidance that was in the CARES Act regarding bonuses. So we've seen that as long as they are reasonable, kind of in accordance with your regular business, that bonuses or some kind of hazard pay, or we've seen people wanting to pay incentive pay to employees that are coming off of unemployment. We've seen that that is just fine. Does that match up with what you guys are seeing?
Yeah, for sure. I think the only limit that we're looking at is that $15,384 to any one individual in the 8-week period. Yeah. So, yeah.
And I hopefully I'm not jumping the gun. Do we want to touch on, so I think we need to address bonuses to employees, but some of them, the viewers might be an employee themselves of their own business. Right. And there is a specific, this is an ugly one. This is something that I know I've advised and is completely contrary to what we have been understanding. And this is, I think, a very important thing for everyone to hear. And that is that owners specifically cannot pay themselves more than what they have been in the past.
Yeah, we do have a slide at the end of the deck. I was saving the bad news for the end, Jake.
Sorry, Tony. Sorry.
But let's cover it right now. So in the instructions, this is kind of a surprise, not included in the CARES Act at all. But what they're doing with owners, and this is like an S corporation owner employee, they're saying that your compensation is the lesser of the amount paid in the covered period or a comparable period in 2019. So if the and so they're going to average it out. So let's say you pay yourself $10,000 in the covered period. They're going to annualize that to what it looks like for a year, and then they're going to compare that to 2019. If 2019 was less, then you're limited. So the basic message is, if you're an owner, employee, you cannot give yourself a raise or take a bonus in the covered period if it pushes you over your annualized compensation from the prior year. So not great news.
Yeah.
Sorry to put a downer on our presentation there. I just felt, I think it was important to notate it there, because we're talking about, because whether maybe someone wants to say it's they, the employee, or their employees, I think it's very important to know that you can bonus your employees, but not the owner employee.
Correct. Yeah, it was probably important to connect the dots there and
Yeah.
not wait on it.
Yeah.
So appreciate that, Jake.
Yeah.
We have one more question in relation to the, I would say, relation to the payroll costs, and it's that top one, that the regular payrolls bi-weekly. Looks like we'll be able to include 5 payrolls instead of 4 payrolls in the loan forgiveness. I think at this point we have to look at when those wages were incurred and earned. The way the application is written is basically, if it was incurred or earned by the employees in the covered period and paid, you can count it, and then you have the little bit of lag time at the end where if it was earned and then you're paying it with your regular payroll, you can also include that. But I think what we were seeing before was that if we had a full month of payroll before the covered period started before you got the PPP loan, and then you had your pay date for that period right after you got the PPP loan. It looks, in the CARES Act, it looks like we should be able to include that. But per the application, because the earnings weren't earned in the covered period, you may not be able to include that.
That's
payroll.
That's a great clarification, and that's not definitive, but it hints in that direction, right? So it hints that you're only going to get 8 weeks of payroll in the application, but there's a lot of people that just disagree with that, including JCCS. So the answer is maybe. You might be able to get 5 payrolls in there if you're a biweekly, but more guidance to come.
Yep.
Yeah.
We also had a question about direct deposit only capturing the net, and it's the gross. You are correct. Your forgiveness is calculated on your gross pay, but for documentation of seeing the actual cash disbursements to the employees, they're going to want some kind of documentation for that, whether it's a bank statement showing the direct deposit go out or the physical checks being cashed to the bank account. That's strictly for the documentation part of the application, and making sure that you are showing what has been paid out to the employees. Right, the top question next kind of leads right into the payroll and non-payroll cost split. Spending 100% on payroll, or do you have to do other 25%? You want to do that one, Tony?
Sure, I'll lead with that and then roll right into the non-payroll costs. So you can spend 100% of your PPP on payroll. If that's what it ends up being, you don't have to spend any of it on the non-payroll costs, but you're allowed to have up to 25% of your forgiveness be these non-payroll costs. So I'll kind of just explain some significant issues in there in the instructions. Really no changes in the definition of non-payroll costs. These are items that you had contracts in place at 2/15, and you had costs incurred between 2/15 and June 30. So that's still the case, and it's because of that language in the instructions that we also believe that payroll is going to allow you to reach earlier than your funded date. So we see no reason why that guidance is going to be different on payroll and non-payroll costs. So application does not appear to require any proration of these non-payroll costs that were incurred prior to the covered period. Still reaches back to that 2/15 date. Another nice feature that they added in here is this exception to the paid rule. So just like payroll costs, they're not requiring you to cut off and pay items before the end of your covered period. So if you've got utilities or mortgage interest or rents, as long as you pay those items before the next bill date on that item, you can pay them outside the covered period and then reach back and include them in your application for forgiveness. So another great feature that they added on, this exception to the paid rule on non-payroll costs. So just talking about a little bit of documentation. I've got 3 slides in here, but they're all basically the same. And I left all 3 slides in here in case someone's referencing these slides later on. But basically they want support proof of the calculations. They want proof that it was paid, and those can come in 2 forms. So we're looking at a contract or a lender's amortization schedule as a proof of the calculation, and then you can provide canceled checks, receipts, or a lender's statement of account from February through the month following the covered period that would verify that those amounts were paid. So proof of the calculation, proof that it was paid. So that's on business interest, and on the lease, same thing, copy of the lease agreement. So here's this specific language. If we have related party rents and there's no lease agreement, then you're deficient on your required documentation and likely can't deduct that. It's an lease agreement and proof of payment. Same thing on utility payments. We're looking at the proof of the calculation. So they want the invoice, and then they want the receipt or the canceled checks. They're also allowing account statements. So again, verification of payments. So it should show amount paid on those account statements. So that's your required documentation for non-payroll costs.
Tony, can you clarify the provision where they're allowing us to essentially, just so you're not having to prepay, I shouldn't say prepay rent, but just so you're not having to kind of get off your rent schedule payment?
Sure. So let's say your covered period ends June 15th. You've got a rent payment for the month of June that's due on June 1st. Well, let's take it the other way and say you pay rent at the end of the month. You would have a rental payment due June 30th, and it covers the month of June. Your covered period ends June 15th. You can stay in your normal payment schedule, pay that June 15th, and deduct the amount that's incurred in your covered period, or include the amount that's included in your covered period in your application for forgiveness.
So you can still wait to pay it until June 30.
Yep.
It's just a matter of saying this is the amount that we're kind of prorating through that date. A, for cash flow, but B, for the benefit of accounting for it in your application.
Yeah.
Okay.
Yeah.
Great. Were there any questions? Anybody see questions? As a reminder, maybe to those who are joining late, we're starting to get people maybe to use the chat box for questions. Please try to push your questions to the Q&A, and make sure if you see a Q&A you like, vote it up, because we are cherry picking from the top of those, just because that's how we are doing things. Were there any questions that stood out, guys? I know I see one or saw one coming up on about what we're going to talk about here in a second. Aaron, were there any that you wanted to try to pick off before I dive in, or are they pretty broad to just keep going?
There's one about healthcare costs normally being due at a given point in the month.
So I'm assuming they're asking that, I'm assuming that's a health, I would want to know if that's a company healthcare plan, right?
Yeah, it would need to be a group health care plan. I think in looking at the other payroll costs, I think you could be fine in paying it along, like paying on your regular schedule, same as with keeping your regular payroll schedule or your regular rent schedules. There just may need to be some allocation. I don't know how you would do that. As long as you get basically two health insurance payments within that 8 weeks, that would qualify. Tony, since it kind of matches up with the rent or something that you pay once a month, what are your thoughts on that?
Yeah, I think the interesting part about group health is you're typically paying in advance of the
Right.
coverage period. So I think in this instance, that's one that's going to be paid during the covered period, and that's what you're going to deduct. So I don't see that the healthcare cost is going to be one that you'll pick up the one after the covered period, because typically that's going to be for the subsequent month, which is clearly not going to have any incurred dates inside your covered period. So
I think we also have another one about non-cash payroll expenses in unemployment insurance and workers' comp insurance. Unemployment is a state-assessed tax on wages, so that is a state and local tax assessed. So you can include that in your forgiveness. The important thing to remember on that, they haven't specifically addressed the payment of the tax and whether you can, or whether you have to pay that early or not. Most unemployment insurance amounts are paid in quarters, so the next one would be in July. So we might get some more some more information on that one. And I think for us, we've taken the stance that workers' comp is not necessarily state assessed, so it doesn't count in that that classification. It could potentially count in benefits. Tony, I know that we've discussed this one back and forth. What are your thoughts?
Sorry, I was monitoring the chat box. What was
about workers' comp and whether it qualifies, maybe not as a state assessed tax, but a benefit?
I've not seen anything that would include work comp. So
perfect. All right. Jake,
right.
Want to help us in calculating out some reduction?
Oh man, yeah. This is where we could spend probably about 2 hours, I think, on these next few slides. So I am going to attempt to keep it pretty brief. I think, I mean, just from a theoretical standpoint, we have to understand that this is a loan that you are applying to be partially or maybe fully forgiven. However, if you do not check certain, criteria, your loan forgiveness amount can be reduced. And one of those ways that can be reduced is what they're calling a reduction in wages or salaries paid. And in general, you're looking, they're using the time frame of your covered period, so your 8-week period, and they're comparing that to what you did in Q1 2020. And then the other just kind of general thing you have to understand is that what triggers the not paying enough is a 25% calculation. So let's look at the next slide, and this is a very very high level, it's a very simplistic example, what the application asks you to do essentially is to list out all your employees, and this is very important. List out all your employees that you have paid during your covered period. That's what CP is on my little thing here. And then as Tony talked about, there's also the alternative payroll covered period. So what's the covered period? That's kind of the 8-week window that your loan can be used for, or you can elect the alternate payroll covered period. And that's just a matter of aligning it with your payrolls. So that's just simply for purposes of this calculation here. So you need to first list out all of your employees that you paid during this time frame, during that covered period. So in this case, we have 4 people. There's an owner, and then there's 3 employees, A, B, and C. And you write down, what you write down is in this case, these are all salaried employees, and you write down their annual salary equivalent, right? Because not just the amount that you paid during that year, during that period, so that 8-week period, they were paid X amount. You need to extrapolate that for a salary amount for the entire year. And then you need to compare it to that same extrapolated calculation from January 1 to March 31. Okay, so there's a lot of math going on here. In the second column, your average wages, that's an 8-week period, so you have to use a different calculation to determine what the annual rate is, because that's only 8 weeks. But then this Q1 calculation is a 3-month period, so you have to make sure you're doing that math correctly, trying to get it to apples, right? And then you compare what you paid during the covered period, column 2, divided by column 3, and you're going to get a number. And you're looking for anything below 75%. Remember, we can pay, nothing triggers until you underpay someone by 25%. So in this case, I mean, you can see the numbers are pretty clear that everyone was paid sufficiently enough. Now, remember what I said earlier, these are all salaried people. This is a very important takeaway here. For hourly, it's a completely different, it's a total different shift in mindset. You're not doing anything with dollars in terms of salary or total pay. It's an hourly calculation, which is completely different than anything that we've even thought about doing before, up until this application has been given to us. So what do I mean by that? Let's assume just for a second, employee C was paid $20 an hour in Q1 of 2020. So everything's going along. They're being paid $20 an hour. The whole COVID thing hits. You get your PPP loan, and now during this covered period, what did you pay him or her per hour? That's the question. That's the metric you use for this calculation. Not in this case a salary number. You would compare hourly wage. So whether they worked 100 hours or 1 hour, it didn't matter. That's what's totally different now under the application guidance. So we didn't, again, we can dive really deep into a rabbit hole here, but just be mindful that I'm doing a lot of salary explanation here. If you've got hourly workers, this is going to will look basically different in terms of doing comparisons. So just something to note there. So let's go to the next page, and this is going to start muddying the water a little bit. Oh, notice too on my example here, the owner, I put the reduction is NA. Remember, not a special rule, if someone is paid more than $100,000, they can actually be taken off of this calculation altogether. So really what you would present to a bank, you could get rid of that owner line. They don't even need to go into this calculation at all. I might show them just for completeness, but just in general, I put NA because it doesn't apply to them. So in example 2, we can see, remember, column 2 is with your PPP funds, and column 3 is prior to getting the PPP in Q1, excuse me. You can see how the wages are less, and so we need to run the math. Okay, the owner was paid $130 equivalent, salary equivalent, right? You didn't pay him that much. It's the equivalent during that period. And then what was that equivalent in Q1? Okay, it's below 75%. However, remember, more than $100,000 salary, don't worry about it. You can skip the owner calculation. But look at A and B. Their wages paid with PPP funds are less than what they were normally getting paid. They fell below that 75% mark. We maybe have a reduction, TBD. And the employee C kind of skated by at 82%, so we can skip them. Now, do we really have a reduction? Next slide. Here's what it looks like when we're dialing in on those employees that we've determined are below that 75% limitation. And this is where we start diving deep, because it's really, you're now just doing all these different equations to hopefully keep it as simple as possible here. You take, for employee A, you would take the 95,000, you multiply it by what the application gives you as just a number, a 75%. That gives you a number. You compare that to what you actually paid, and then you get, yeah. The number here calculates out at $962. Let's just go to that. For employee A and employee B, there's a reduction of $400. You can go back through our slides, do the math, look at the application, figure out how we did the math here. On the surface, this company would have a $1,362 reduction. Why? Because they didn't pay enough to these two employees based on what the guidance is of a potential reduction of your loan. However, with the loan application, they have provided guidance with a potential safe harbor. And if we go to the next slide, this shows how the safe harbor kicked in. Go back one, Aaron. This slide shows how the safe harbor kicks in, and this is yet even more complexity in how to get this number. But you can see just on the surface that using the safe harbor, they had a almost $1,400 reduction. Employee B actually was able to trip the safe harbor to allow that $400 to be removed, and only $962 was reduced. To try to frame this as general as possible, the safe harbor essentially says this. It says you look at what you were paying an employee, and again, these dates are just, stick with me. You look at what you were paying an employee as of February 15th. On that day, what was their annual salary extrapolated? What's that number? Then you compare it to what their annual salary extrapolated out would have been from the period of 2/15 through 4/26. You can't make this stuff up. From 2/15 to 4/26, and you get a number. You compare those, and if the 2/15 to 4/26 date is greater than or equal to the February 15 date, no safe harbor. And let's think through this common logically, right? Way before COVID, well, I mean, February 15th, before COVID. Now let's look at a time frame that we think kind of COVID would have affected you. If there was no reduction in salary or anything, they're not going to give you the safe harbor. However, if they see that, okay, between the 2/15 to 4/26 date, you have this, it dipped. Okay, maybe you trigger a safe harbor. So yet one more arbitrary number, and this is actually, we've heard of this date, June 30. So for the safe harbor to really kick in, if you did have that reduction during February 15th through 4/26 compared to just February 15th, then you can qualify for a safe harbor on this employee if you restore their salary as of June 30 back to the February 15th timeframe.
Clear as mud.
Clear as mud, right? That's how you briefly explain this rule. Now, again, 10,000 foot level, there you could have wage reductions. However, if you think of it from the perspective of if you were paying just fine and everything fell off and you think you're going to get back to that level pre-COVID by June 30, chances are you're going to be okay. You're going to trigger the safe harbor, and there's not going to be any loan reduction. So that's really, I think, the big takeaway is, one, know that there's a wage reduction calculation out there. I think this is an overlooked area. Same with the FTE reduction. It's an incredibly complex calculation, but you can get into a world of hurt if you're not looking at these specific areas. So the final example, because I know we're all really ready to learn more about this wage reduction area, are just some extreme examples of what might appear to be a risk, but actually is really not too bad. So again, remember column 3, January 1 to March 31, that was kind of, we were rolling just fine. Owner was getting paid at a rate of $130,000 a year. COVID hit, totally took a drastic pay reduction. And what seems like this underpayment, remember, they were getting paid more than $100,000 per year. Forget it. Doesn't matter if they didn't get a dime. No reduction in your loan forgiveness application. Employee A, you had somebody, you had a 25-year employee, and they were making $95,000 a year through the end of March. What'd they do on you? They retired, right? Pre these guidelines under the application, that would have affected you because you were going from someone that was getting paid to what were they getting paid during the PPP period. Well, they were gone, so that was an unintended consequence. Well, they're protecting you because, remember what I said, this list needs to be the list of people you paid during the period. This person that retired, you didn't pay, so there is no look back. You don't have to worry about it. So you actually wouldn't even have employee A on this list. But I just wanted to show you for an example of someone that you had pre-PPP and that's no longer there.
Jake, I think that's probably, that's probably the biggest difference in the plans that we've talked through with our clients right there is, rather than looking at the previous full quarter and making sure everybody got paid in the covered period, it's exactly opposite. Covered period employees compared to what they were paid previously. So big distinction there.
For sure. And that was, as Aaron will talk about with FTE stuff, that was kind of a double whammy, right? You were getting hit by a wage reduction as well as an FTE issue. And you still could have an FTE issue in this example with employee A, but at least you're not getting dinged as well from a reduction standpoint. And then just very quickly, B was hired during COVID. So there are no wages to look back on. So obviously, you're not underpaying them there. And then very common one, I guess this is more COVID related. Employee C went on unemployment. So they were trucking along in Q1. COVID hit, they fell off, your store closed. You're not paying this person anymore, right? Drastically under 75%. So, you're thinking, well, it's not 72, it's not 70, it's 20% in my example. They potentially would not they would not reduce your loan forgiveness application. Why? Because in this example, specifically, why? Is because you're going to hire them back. And remember, you would fall under that safe harbor, right? What were you paying them during Q1? What were you paying them during the PPP? You went way below the 75%. However, if the safe harbor can kick in and you get them back to the June 30 levels, you're fine. No reduction. Enough on that. Very, very. It can be really simplistic, but then it can be very complex depending on someone's situation. And I really do think if we've got someone out there with a bunch of hourly workers, I think there's going to be some weird catches. I think the safe harbor is going to get blown up with the hourly workers based on the way they're written. And I guess I'll go down a rabbit hole if I talk about that. But I do really think just if you have a lot of hourly workers, do not take this wage reduction lightly. I think you're going to get tripped up with the safe harbor. I don't think it's going to apply. And as you work through those calculations, you'll see why. You'll see why.
I think with that, almost all of the tools that I had seen come out after the CARES Act was issued and some further guidance, I can't think of one that did the wage reduction calculation like this. For salary or hourly, it didn't matter. No one calculated it like this, at least that I saw. So it's interesting to see that the SBA would go this really cumbersome route. Luckily for me, the FTE calculation is a little easier. But having said that, I think we originally started our FTE calculations using 40 hours as the full-time equivalent number of hours per week. Really, a lot of the tools out there, I'd say the vast majority, used 30 hours a week. So we kind of fluctuated back and forth using 40 or 30. Per the application, 40 hours a week was the one to use. So again, if you were being consistent in how you compared your FTEs from one period to another, whether you use 30 or 40 shouldn't really hurt you, because you're using the same divisor there. You're using either 40 or 30 and getting a number. You're using it consistently. You should still be fine. But 40 hours per week is the base full-time equivalent. There is a simplified method that you could use. For anyone working 40 hours a week, you can count them as 1. Anyone working less than 40 hours a week, you count as 0.5 for all of those employees. So that's your simplified. If you know that you have 2 people working 40 hours a week and you have 2 people that each work less than 40 hours a week, you could use the simplified method to say, hey, I've got 3 FTEs. So very easy to do, or you can do the more complex calculation where it takes your actual FTE count using the 40 hours a week for the base equivalent there. You will need to calculate your FTEs multiple times. Usually you'll want to look at the average for the different look back periods. The one look back I didn't include on this slide is that for seasonal employers. That one's a little different. But you've got your 215 of 19 to 630 19 for look back number 1, or you can choose the 2020 look back, which is 1/1 to 229 look back. That's an average per payroll per month. And then you'll also need to calculate your FTE between 215 of 2020 and 426. And that's to help calculate out the FTE safe harbor, which is very similar to the wage reduction safe harbor. And I have a slide on that in a couple slides. And then you'll also want to calculate out the FTE at 630 to round off that FTE safe harbor election. So you may have those 4 kind of relate to different, each one seems to have one, how should I say this? Each calculation has a corresponding calculation that you'll also do. The 5th one, of course, is the FTE for the payrolls that you're running during the covered period. So that one will then correspond to, in our list here, either 1 or 2, depending on which look back period you choose, or if you choose a seasonal look back period. And then the FTE numbers 3 and 4 here correlate together. So definitely a lot of calculations. 40 hours is the one that you'll use, the number of hours that you'll use for determining the FTEs, but definitely a lot of calculations just for this purpose. The question there's been a lot of confusion on when we're counting the FTEs, why we're doing it. As a reminder, we have to calculate the average FTEs during the covered period and compare that to the average FTE of one of the specific look back periods. So typically we're recommending do the FTE calculations for both look back periods, so you can determine which one's going to be more favorable. Then you can decide which one to use, but you will need to calculate your averages. It's not just a set in stone, these dates, unless we're looking at the safe harbor. All of these calculations will be submitted with the loan application for forgiveness. That's what that one slide that talked about documentation for the FTE calculation, that's probably going to be your documentation here, whether you do it in Excel or you handwrite it or whatever you're using. They're most likely going to want to see a copy of all the calculations that you've done. So the FTE safe harbor is, like I said, very similar to the wage reduction safe harbor, in that if you reduce your FTEs from February 15th to April 26th, and then restore your overall FTEs by 6/30, then you can exclude them and you're exempt from the FTE-based reduction of loan forgiveness. So this would be if you put people on unemployment, but then you've brought them back by 6/30, you don't have to include those people in any FTE reduction calculation. There is some guidance out there for people that have made job offers and then the employees have rejected that job offer. If you have the written job offer, the written offer of employment, and you have some documentation that the employee rejected that offer or accepted it, then you should be covered in those instances, because it's not you've tried to restore your FTE count, but the employee is not necessarily following along in that restoration. So it's not by any fault of yours as the employer that the employee won't come back. So something to keep in mind, definitely have that written documentation. I've had conversations with a couple people who they are using either read receipts on their emails with the offers and then getting a response back. We have some people using a tool like DocuSign or any of the electronic signature things that show when an individual viewed the document as their proof that they sent it. So definitely try to have some good documentation around there because that will most likely need to be included in your application for forgiveness. As an example, so we took the same kind of information that Jake used. We have our owner, we have employee A, B, and C. Here we have the owner working 42 hours in the covered period. His historic hours worked in whatever look back period we chose is 40. Employee A was working 45 hours in the covered period and also worked 45 historic hours. In those instances, when someone's working overtime, we just count that as one FTE. That we only look at the 40-hour mark, not the overtime, any overtime hours. Employee B worked 32 hours in the covered period and historically had worked 40. And then employee C worked 16.75 average hours in the covered period and historically they worked 24. So we're going to get all of those calculations. You can see we had 2 employees at the 1 FTE, one at 0.8 and one at 0.7. So here we have 3.5, Tony? Check my mental math for me. 3.5 FTEs. So if that matches up with our look back period, we're fine. Now, if it doesn't, we have a problem, and it's most likely not going to, due to the reduction in employee B and C. And that reduction is a percentage based on your costs. So here I can't give a specific dollar number because I don't necessarily know what the loan amount or how much was spent on the different items. So just know that that's going to be a percentage decrease of your total costs that you've spent. Tony, can you mention, I know we're coming up right at 10, can you mention that quick thing we talked about last night about the payroll and the non-payroll costs being affected by this percentage?
Oh my goodness. Yeah, so apparently how they've calculated this, the application, maybe I'll cover that when I do the self-employed,
Perfect.
because I can show a visual there. So
Perfect.
yeah.
So just be aware your payroll and your non-payroll costs may be affected by this differently than what we expected previously based on the CARES Act. So calculating out any safe harbor, let's say this employee C, who had an average work, the hours worked was reduced, he went on unemployment between 2/15 and 4/26. And then he was brought back as of 6/30, restored to the same position, same rate of pay, all of that. Then I would be able to exclude that person from the FTE calculation or any reduction calculation because we brought him back. That's part of that safe harbor that he would be eligible, that we would be eligible for in bringing anyone back. So something to keep in mind here. It's a pretty basic grid. I personally think it's a lot easier to calculate over the wage reduction calculation. Like Jake said, they kind of took away from the double penalty almost on the forgiveness reduction due to having a reduction in FTE and a reduction in wages. So that's a quick and dirty FTE calculation example. Anything else on that, you two?
We've got a ton of questions, so I'm sure we'll get to diving into more details there. So real quick, just the rest of the content, just a couple of minutes here. This is that owner employee compensation slide. So it's in there for your reference, but it's limited to the lesser of gross pay over the covered period, capped at that $15,384, or the 8-week equivalent of their applicable compensation in 2019. So no bonuses, no raises. Now, I'm going to take a second here to expand because I think it's going to hit on some questions. It's the annualized amount. So if you held off on paying yourself the first part of 2020, and then you increased your pay in the covered period, you got to increase what you pay in the covered period, even though that may not equate to what you normally get paid. So if you paid $15,000 in the covered period, you got to annualize that out to, and that's going to be close to like $95,000. If that $95,000 annualizes more than you got paid in 2019, you're going to have a limitation. So I want to be clear that it's the annualization of what you pay in that 8 weeks. It's going to be the measure. So then I want to touch real quickly on the self-employed piece, and that's on the next slide. I don't want to ignore it, but their application for forgiveness is going to be super simple. We're talking about the self-employed owners or the general partners with no employees. With employees, you get all these complexities that we've talked about. But a lot of the Schedule A is not going to be applicable. However, self-employed, no employees, full forgiveness is absolutely not possible based on the formulas that they've provided. You get close, but you can't get there completely. So I've shown a couple of examples on the next two slides. So this is one where we got 95,000 of self-employment income. If you do the divided by 12 times 2.5, you get that PPP loan amount of 2312, which is down on line 9. And then we know self-employed, the amount that they can count as payroll costs is forecasted. Okay, it is predetermined. It's for this loan, it's capped at 15,000. So I put in some pretty high business costs. Clearly, they are more than 25%, which gets me to a modified total of over my PPP loan amount. But that line 10 is always going to limit me to something less than my PPP loan amount. So something to note there. This also kind of demonstrates that comment that Aaron was asking me to expand on, is that for businesses, if you have significant line 2, 3, and 4 costs, and you have a reduction factor on line 7, by increasing your non-payroll costs, you're going to basically null out the effect of that FTE reduction quotient. I don't want to get too detailed there, but we've run through some various calculations, and it's pretty interesting that high non-payroll costs can essentially null out that FTE reduction quotient factor. So kind of some interesting nuances. Math nerd stuff. So then on the next slide, I just want to also demonstrate an instance where we've got lower non-payroll costs. Same thing, we're going to be limited to that modified total. So we never get to that PPP loan amount. So both of these are that self-employed, no employees example, where you're never going to get to that full 2312. You get close, but not quite. So with that, should we shift over and start chipping away at some of these questions? I know we're past time. We're at 10:05. So those of you that need to tune out and get on with your day, please feel free. We want to thank you for joining us. And with that, we're going to jump into some of these questions, and we'll stick around as long as we can.
I'll tackle the first one.
Yeah, or Jake, can you talk about utilities again?
Yep, CARES Act pretty well lines out what exactly qualifies as a valid utility for a non-payroll cost. Cell phones are the big question right now because there really is no specific guidance. Telephone is listed though, so I would imagine that if you provided those proper cell phone bills, that they will allow it. So I think we leave it at that.
How about paying by credit card? I've had this question a couple times.
If it's anything like, basic tax stuff, it's when it gets swiped. So as long as you swipe that card, I think that's deemed paid. That's good enough. Yeah.
I'd agree.
How about hiring of a spouse?
As it applies to everything we've talked about, it might depend, but I would imagine maybe what they're thinking is we need to use our PPP funds maybe. First question is the spouse an owner? Got to be careful there, because if they're an owner, you can't pay them more than what you've paid them in the past. And if in the past it's zero, you can't pay them. If we're looking for PPP loan forgiveness, any other thoughts? Perfectly acceptable. Document the hours that they're worked. Mm-hmm. Just like any other employee.
Yeah, if it's reasonable and necessary, I think there's no way that would be questioned. So.
Yep.
There is a question about payroll costs. Can payroll costs include payments to contractors? And that is not the case, as far as I remember. I didn't think there was any updates to any guidance that they'd issued. Payroll cost is payroll, basically going to be reported on your W-2s, 941s. Don't think it can include any payments not reported on those employment forms.
Yeah, they've emphasized it does not include. Yeah. To answer the question about someone asking if we're gonna have the answers to these questions. We attempted to do this the first couple of sessions, and the amount of time, there's so many great questions and we spent so much time typing them out. It's going to have to be limited to what we answer here. So go back through our recorded webinars to see a lot of answers. We usually take 40 minutes at this point to answer. So consider that how you get answers to our questions, please, just for our sake.
So I'll define transportation. That's the next one that's up there. Transportation is going to be fuel costs for business vehicles. So if you've got heavy equipment or trucks or cars, that's what they're talking about there. So transportation is fuel cost.
I will answer the next one as it relates to the wage reduction calculation. And the question is, what if you have turnovers in employee? What if you have turnover employees? Employees are different than the first quarter. In terms of the wage reduction, remember we list out the employees that you paid during your covered period. So I don't care if there was turnover, it's who did you pay? Now compare it to what you paid that person in the prior quarter and do the math from that point. So if the turnover, you don't care about the person that left prior to the PPP. Now, if they left during, that's a whole nother issue. So that's how we relate to the wage reduction. How about FTEs, Aaron? Any thoughts on that?
If you're replacing your employees, you shouldn't have a significant swing in FTEs because they would count as one, depending if they were a full-time 40-hour-week person, they'd count as one employee in your look back if you're using the 1/1 to 2/29 2020 look back period. So you've got your one person there, and then if you bring the new person in, they're going to replace that one FTE. So you shouldn't see a significant shift. It maybe in the average pay or the average amount of FTEs in a payroll if there's a gap in between when you brought them on. I don't see a huge FTE issue there because you're replacing someone who's already there or who was working, should have the same similar hours most likely.
And I know the person that sent that question. If we didn't answer it, please email me. Happy to expand.
Yep.
Can we give the PP money back, or has the deadline passed? The answer is it's a loan. You can always pay the money back. However, perhaps why you're asking this is that you've realized that maybe the tax credit might be better, and the answer would be is you have missed the deadline. Asterisk, they've extended it twice. Will they extend it again? Stay tuned.
Well, I think they're, they always extended it before the deadline, and we have passed the 18th.
Right.
So I think the thing to look for there is the next act, the next legislation may just wipe out that ineligibility of the credit.
Sure.
I might say you can do both, but yeah, the safe harbor is gone.
Yeah.
And I believe interest starts accumulating on the date that the loan is funded. So that is the first date that money was deposited into your account. Expect interest to be accumulating from there.
And our understanding is, let's say during this 8-week period, you accumulate $1,000 of interest, and let's say 80% of your loan is forgiven. Our understanding would be is that 80% of the interest would be forgiven as well. So if you get your loan fully forgiven, 100%, then all the interest accumulating would be forgiven as well.
And then we've talked about that time frame for how long loan forgiveness will take. So once you submit, check my dates here, Jake, but the bank has 60 days to consider it.
Correct.
And then the SBA has another 30 days to reimburse the bank.
Correct.
But at the end of the 60-day period from the date your complete application is submitted, that's the deadline for the bank.
Agreed. I'm just going to read this out for viewers and panelists. They applied for the PPP loan before fully understanding the payroll calculation. Use 2019 payroll divided by 12 to find the average monthly payroll, multiplied by 2.5. Okay, I'm tracking. Because we pay biweekly with 4 paydays within the 8 weeks, they're coming up short of 75%. Do I need to return some of the loan to get us to 75%? You don't necessarily need to return the loan. Your loan forgiveness is going to be, it sounds like if you're coming up short of 75%, then your loan forgiveness is going to be reduced down until your amount gets to 75%. And at that point, you either have a loan or yes, you would return it if you don't need the money. That sound okay?
Yep.
Okay. Next question, special considerations for forgiveness process for nonprofits. Not that I can think of. Aaron or Tony, surprisingly, they got kind of the shaft on the credit a little bit. But there's no industry or type of person or type of business issues here, so shouldn't be.
So on the next one, Jake, I know when we were talking in our other webinars, and I believe in the CARES Act as well, we're talking about employees and or positions. And I think this next question kind of talks about that, where you have an employee that was replaced someone else. If you're looking at that position, when you're doing your wage reduction, do you use the position name instead of the employee's name, or how does the application talk about that position employee?
Yeah, it's a good question. So it's not. We originally interpreted it as it being a position for position issue. We probably talked about that on a previous webinar, and then these new rules came out. So to attempt to answer the question, the first thing I would need to know is, when did this turnover happen? So in this example, they're saying someone quit, then they rehired. When that person quit is really the key. If it was during your PPP period, during this 8-week period, you might have an issue, and you got to run the numbers for both. The person that quit, what did you pay them during your period? What did you pay them in Q1? Run the math. The person you hired, if this is a brand new hire, no issue, right? You're paying, there's no reduction because you never paid them prior. So you would list them, but then at the same time, there's no wages to look back on, no issue. So yeah, and I think the key is, when did this transition happen?
And I think we've got conflicting guidance, because in the FAQ from the SBA, the question was asked, can I rehire an employee? And they say yes. But the instructions clearly don't. They talk about list all your employees. They don't say list all your positions.
Right.
So perhaps that's some of that additional narrative guidance where they clarify that, yeah, we say list your employees, but what we really mean is list your positions.
Yeah. And the safe harbor does not talk about, it's not talking about the rehiring. Yeah. Okay. To your point, it's not talking about the rehiring of that position. The safe harbor talks about that one individual. It's an employee. It's that individual specifically.
Yeah.
So maybe unwritten, unintentional issue there. That's for sure.
Yeah, definitely some conflict.
Yep.
What is both of your opinions on the SEP retirement plans or profit sharing contributions to 401ks or anything like that? I know that we can accrue the expense and pay it into the 401k plan if your SEP plan, depending on if your plan allows for that. At that point, it does become payable to the employee, though. If they leave, can someone wait until the end of the year if that's the regular time frame that they make the contribution?
I don't think so. Let me kind of address this from a couple of different, because I've had some emails also, so I'm going to kind of cover it a little bit globally. So the instructions, first of all, it's a bad description of what you put on the line. It says input all retirement contributions paid during the cover period. So I've had several questions of, well, I'm about to fund my 2019 contribution. I'm going to pay it during the covered period. Do I include it? So the answer is no, because it's not incurred between 2/15 and June 30, clearly. And it's not covering any wages that are in the covered period. But I also think that's one of those that there's no guidance where you can say, I'm going to pay it on my normal cycle, because it's going to be outside of the deadline for application for forgiveness, outside of that October 31st date. So I think that's the one that you got to measure and pay. Yeah.
Perfect.
Anything to add there, Jake, or is that?
No, it's such a great question that I think you got it.
So we're getting a
Um,
lot of questions about hourly employees, and to make
yeah.
an example,
Shoot.
I would personally, Jake, this is more towards you though.
Yeah.
If you have someone at the firm that you work with, I would reach out to them for assistance on calculating the hourly employees. I don't think there's just a simple example to do for them. Would you agree, Jake?
Yeah. I'm thinking back and what I'm saying. I hope I didn't scare people. I just think it's really Tony and I, well, all three of us, were running the numbers, and it's like, holy cow, is this really what they're? Is this really
Mhm.
actually what? Am I calculating this number correctly? This doesn't seem right. So yeah, I mean, it's really for hourly people. It's based on the actual hourly wage. Let's say I'll do this as an example, as brief as I can, and I know everyone knows I can't be brief. Okay, so if you're paying someone prior to COVID 20 an hour, and then during this time frame COVID hits, if you don't change their hourly rate, you don't qualify for the safe harbor. That's
Correct.
I think that's a huge takeaway. Huge, okay. And I mean, let's be real. Who would drop someone's hourly rate? You're going to cut their hours before you cut their rate. That's just a fact. And for all the bar and restaurant owners out there, I mean, you might already be paying the minimum wage. So it's like you can't cut their right. So that's, I think, a very important takeaway. If you increase someone's wage, obviously you're definitely not qualifying for the safe harbor. And if you're increasing someone's rate, I would think you're doing well, and you probably didn't reduce. I mean, you're probably not dealing with a reduction, obviously. So you would have had to have reduced someone's rate to kind of trigger the rate reduction, I think, is maybe what we could leave it at.
Yeah, I think that's a good synopsis, Jake.
Yeah.
It's a really interesting calculation, and I think people need to run it for their scenario.
Yeah, very good. Those three were all about that. Okay. And then we already talked about telephone, internet, including utility expenses. Yes. We talked about that one a little bit. I guess to clarify from a wage reduction standpoint, yes, it would have to be that employee that you're trying to qualify for the safe harbor on. However, for FTEs, I don't believe so. Right, Aaron?
Well, I think the FAQ, this is where we've got some differences. The FAQ says you can make an offer to somebody else and rehire a different person for that position.
Okay.
Yeah. So, but I mean, again, it's a difference in the language in the instructions versus the FAQ.
Yep.
There's some divergence. It's not perfect, but we believe that you can make an offer to another person. You don't have to rehire that same person. But again, if we're looking at someone who was laid off prior to the funding of your PPP, it's not going to matter because you're looking at the dollars paid to the employees during that 8-week period, right?
That's right. Yeah. So
you might have an FTE hit.
Correct.
But dollars paid, you're going to be fine.
That's what I think too. The next one is in regards to the 8-week period when they received the loan and still couldn't reopen. This is the number one hot topic, I think, across the nation, is that we got our money. We're told, let's get it because money's going to run out. We got it. Oh, wait, we can't open yet. But you need to spend all that money by 8 weeks. So unfortunately, it began the date the money was deposited into your account. The funds were available. That's when it starts. Not when the first payroll began.
Yeah. Go ahead, Aaron.
No, you go ahead, Tony.
I was just going to say, I mean, the predominant opinion is that 8 weeks is going to get extended to as much as 24 weeks in legislation. So everything that we talked about the last hour and 24 minutes is potentially out the door, but there's a lot of discussion about extending the 8 weeks. So more to come there, but these are the current rules.
Yeah. I think the next one is in regards to that adjusted payroll period. Do you want to tackle that one, Tony?
Yeah, so the ones that can adjust to the pay period are only biweekly and weekly. So if you're semi-monthly or monthly, you're under the original guidance of when your covered period starts. You're not allowed to shift. So only biweekly and weekly.
And the next one has to do with that same theory, but then do we also have to shift our 8-week period for non-payroll costs?
No.
Right.
Well, yeah, I mean, so you've got a new covered period, right? So the answer is yes. You've got a new covered period. If you've made an election to change your covered period, it applies to payroll and non-payroll. Yeah. You don't have two different covered periods.
Gotcha.
So, Jake, you want to take that lease agreement question at the top?
Yeah. Do self-rentals need a written lease agreement in place, even if rent has been constantly paid for months or years? And the answer is yes. Most definitely. That's going to be the first thing they ask for you when you submit that application is, where's your lease agreement? This person typically pays themselves. They're the owner, partially through payroll and partially through distributions. However, for easier documentation, they put all pay into payroll for the 8 weeks. Is that going to affect it negatively based on what you mentioned about comparing it to 2019 payroll? Yeah. I mean, you can do it, but in terms of how much you can have forgiven, the limit is going to be based on an 8-week equivalent of your 19 pay. So what did you pay yourself in 2019? Divide that by 52, multiply it by 8, and that's your max forgiveness for your PPP loan. Bright line. Can't believe we got one, but we got one. And it's unfortunate. It's very unfortunate for the owners. That's for the owners. Clarifying, that's for the owners. For hourly employees, we reduced overtime. Do we use the actual hourly wage that we would need to recalculate?
Not sure. Not sure what that's quite asking. I think it's saying we reduce overtime for hours for the FTE, but it's included for the dollars paid.
Also, if you were maybe to take your total gross wages and divide it by the number of hours, you get a different average hourly rate. And then when you split out your regular versus overtime, I would think you'd be fine using the regular rate, because that's all, they're just looking at regular hours. So this is kind of an extrapolation off of the FTE calculation, because that they're using just 40 hours, nothing over that, no overtime. So I think the argument could be made to just use the regular rate of pay, because overtime isn't necessarily a guaranteed thing. Thoughts?
I would agree.
Yeah, and kind of thinking through how they word the calculation, I think you're spot on, Aaron.
Yep. Benefit costs. Are both the employee and employer costs covered? Tony?
Yes, because the employee portion is typically, so we're probably talking pre-tax items. Mm-hmm. So we're talking gross pay. So it's included in the gross pay. Mm-hmm. So then when you input the benefit amount in the application, it's going to only be the employer portion because the employee's portion is already included in their gross wage. So
let's say it's like a 401k match, maybe they're asking about.
Yeah.
So the employer portion.
Yep, only the employer portion because the employee portion is already in their gross wage.
Built into the wage, correct. Yep. On a monthly payroll, we pay after the month. For example, wages paid on May 1 were for April. We received the disbursement on April 23rd. May payroll wouldn't count, and the cutoff is the end of June. So we wouldn't be able to use 2 payrolls for this, question mark. Talked about this one, I think, in length. Any comments, Tony, specifically to that? I mean, we're just kind of, the answer really is, I mean, they're allowing you to kind of adjust the period in which you're paying to align with your payroll. I think that's kind of the big thing. Oh, well, excuse me. This one you cannot, right? This is a monthly.
Yeah, so this is where we believe that you can.
Right.
We believe that you're going to be able to count that in your PPP because it's incurred between 2/15 and June 30 and paid in your covered period. However, the instructions hint that there is that the incurred date must fall in the 8-week covered period. So we expect more guidance on this. Us 3 panelists, we believe you can include it. But word of caution that there is some hint that there's that allocation that's going to be required. So.
I feel like the next one we've kind of addressed. Must all payroll be paid prior to end of 8 weeks or by June 30? I think that's we've been harping on that one. It's got to be paid inside or accounted for. I guess to further elaborate, if you are on a accelerated payment of your payroll, that final payroll you can in theory pay under your normal course of when you pay it and accrue for the expenses through the end of your period.
Mm-hmm.
So question on lines 8 through 11. Certainly they're, based on each business's circumstances, you may end up being limited to that 75% of payroll. But if you're having trouble with the math, pass it by, someone that you work with at JCCS or email it to me. I'll look at it. Certainly. So if you're having trouble with lines 8 through 11 and it doesn't make sense to you, just have one of us check it. So there are, each person's circumstances are going to be unique. Mm-hmm. But we've run different scenarios where we see that the loan forgiveness amount can be line 8, 9, or 10. So they're, all across the board on circumstances. So happy to look at those though.
Yep. So an employee started a work comp claim in mid-March. 8 weeks started mid-April. Employee work hours with the company will be less than the Q1 because of this, but they are getting work comp from state fund. How does that affect reduction calculation?
It doesn't, because they're not getting paid by the company in the covered period.
When did they stop? Yeah, so did they pay during the period? Yeah. And if the answer is no reduction issue.
Yeah, so if there's no wages from the company in the covered period, then it's not an issue. But if you're paying them partially or maybe they come back like the last 2 weeks of the covered period, now you've got an issue where you've got to look at that. Yeah. And undetermined whether you count the amount that they got paid from work comp in, do you add the company plus the work comp pay? I think that's a question that we don't have an answer for.
Right.
That may affect your FTE, your average FTE as well, yeah, depending on which look back period you choose. Well, yeah. So potentially a reduction on on the FTE side of
Good
things.
point here. Good point.
Yeah.
If employee quit and they were not rehired or they were terminated, can that employee also drop off the calculation for the wage reduction, but they should still be counted for FTE? So depends when this happened. It's all about timing. If it was during the PPP period, you could have an issue. You got to run the numbers. If it was prior, no issue for the wage reduction. And then for the FTE, I guess that would all be determined based on if they get rehired. If not,
Potentially. It really depends on, so with FTE, you can have more turnover that won't necessarily affect your average FTE. So if an employee quit, but you replace them, depending on what look back period you're using or what your average, like the timing of that, it could affect your FTE. You would still, if they quit in your look back period, you would still count them. It would still affect your FTE, but it really depends on look back period versus if you had any replacement or anything like that. So FTE is like, it's not employee or position specific. It's more hours worked specific.
excellent.
Real quick on the next question, if employees annualized rate is greater than 130,000 is up to 100,000 forgivable. Not exactly sure if they're asking if 100,000 is forgivable, but remember, anybody who annualizes over 100,000, only 15,384 is going to be forgivable on the PPP for any one employee. So hopefully that answers that question. 15,384 is the limit per employee.
Yep. The next one, employee health benefits are forgivable expense. I'm assuming they're assuming that I'm assuming it's because it's part of their pre-tax wages. So I'm thinking that's why they're saying that. But does the health benefit have to have been in place for a certain amount of time? In other words, can I offer my employees a new health benefit and have expenses during the 8-week period forgiven? Huh.
I don't think it's addressed.
I don't think that would be an issue, right?
Yeah, I don't think that's addressed. I mean, they definitely talk about non-payroll costs having a contract in place by 215,
Yeah.
but I don't think they address benefits.
Yeah.
No, I don't think so either. Should be fine.
If anything, I think they'd be like, they're trying to encourage employers to offer health benefits to employees. So I think it would be, I mean, maybe not Congress. I think it would be somewhat counterintuitive to not be able to offer new plans to employees, but who knows? There's a lot of stuff about this. It's a little,
Common sense is often
yeah.
not okay, it seems like. Can you clarify forgiveness on mortgages for real or personal property? This person has a non-tangible asset, so maybe like since customer relationships or customer list or something maybe that they purchased for an asset sale. Would this count as property that they've been depreciating? Would this count as property to be forgiven?
Ooh.
No. I'm not sure. Okay, so they purchased. Oh, okay, maybe. So maybe they purchased a business for X amount, and inside that purchase is these assets. Yeah, okay. Yeah. I'm buying that. Do you agree, Tony? Did you hear the question?
I agree. Any business assets, mortgage interest on
Yeah.
business assets is
Sorry.
easy go.
The interest on that loan.
Mhm.
I'm tracking now. I misread that. Yep. Is there a percent requirement of ownership to be considered an owner when looking at wage limitations? No. Owner employee. Anybody hear anything different? I don't think it matters as long as whatever percentage. Can wages paid to a staffing agency be counted towards 75% of the loan if we were paying a staff agency in 2019?
Yes, but you need to get information from the staffing agency on the actual compensation that the employee was paid.
Mm-hmm.
So it is not the amount that you pay the staffing agency, it is the amount that the staffing agency pays the employee. I know this has been a sticking point because there are staffing agencies that are not forthcoming with that information. And I know there are staffing agencies that have applied for a PPP and counted those people as their employees, and have issued written letters to their clients saying that, no, those are our employees, and they just misunderstand the guidance. So, but those leased employees are your employees, and you can include the amounts that the staffing agency pays that employee as compensation.
The next question has a very open-ended lease agreement question. So there's no dollar amount listed for rent. So I have no idea how that would be addressed. I would maybe, if I'm the IRS, I interpret that as zero. But obviously, I would think that maybe you would either have to turn to fair market rent or historical, which is, that's just a simple assumption at this point. I would say you might be left hanging to dry there. I don't know. They don't address that. Can you go over the dates of the covered period you refer to? Is it individual from the date of the loan?
Mm-hmm.
Yeah, it's the date the money hit your bank, unless you elect the alternate covered period if you're a bi-weekly or weekly payer. And then you can advance the start of that to the first day of your next payroll. So,
and
but
that's and it's still an 8-week window, though. It's still a finite number of days.
Yeah, I mean, we're getting to where, there's PPP funds still available, and we're getting to where your covered period will extend beyond June 30th, but we've got some June 30 measurements in the guidance. So we're kind of running into this really kind of clunky period.
Yep.
So, yeah. Confirm again. Yes, the EIDL does turn into a loan. The advance under the current instructions, if you got an EIDL advance, that will turn into loan. So Jake, we're coming up on, we're going to do a hard cut in about 3 minutes. So we'll take just a couple more questions.
Great. Maybe tackle then. I'm going to go down through and cherry pick to see if I can see any that are really applicable to what we talked about today. Maybe look for some older ones too.
While you're doing that, I'm just going to answer some of these easy ones. If you've got an employee who changed positions during the time period and had a reduction in pay, that will affect. So you've got dollars paid because you're measuring that based on listing the employees that you paid. So if they went from a experienced to non-experienced or something that forced them or required them to have a reduction in their pay, that would impact your calculation. Seeing anything that you really want to hit on there, Jake, as maybe a last question?
I think I feel as if we've at some point addressed almost, here's one that we haven't really talked about, is the forgiveness amount taxable. This is kind of That was one that we kind of addressed in the previous webinar, and it's not taxable. It's tax-free. However, the expenses are not deductible, which when you cross your eyes and look the other way, it means it's taxable. So the intent is basically from the IRS to not allow you to double dip, get tax-free money and take a deduction. There's a specific IRS code out there that says you cannot deduct an expense against income you receive tax-free. So that's the reasoning behind it.
So that's current rules, and we've got the good folks at the Congress who are trying to reverse that, I believe.
Yep.
So, well, we are at 10:45. I know we've tried to keep up with the questions. We've still got 104 in the Q&A, so we apologize if we did not get to your question. Please feel free to reach out to us if there's some questions that you didn't get answered. I know some of those are repetitive in there, but if there's something specific with your situation, we'll be happy to try and get you some guidance on that. That's what we're here for. So again, thank you. Hour 45. We appreciate your time. Everybody who stuck in and listened to all the Q&A. So have a great day, and best of luck with your PPP application.
Thanks, everyone.
Thanks, everyone.
Thanks for joining us.